You can learn about finance, financial modeling with your host Matthew Burnett.
Hi everyone, today I'm going to be talking about some of the risks that we find in project finance and how we mitigate those risks. And I'm going to be talking through this article that you can go and find over at my LinkedIn page. And the article is entitled Project Finance Risks and Mitigants. And in it you'll see a picture of me looking out the window and I'm saying an important part of project finance is understanding the risks involved and then allocating risks to the parties best placed to handle them. And that's really what project finance deal making is largely about. So let's take a look at some of the risks. So why risk mitigation in project finance is so important is we can see here that I've said that deal structuring and negotiation allow a brand new SPV, in other words an SPV that's never operated before, to take on a lot of debt and some equity to build a large infrastructure project with loans that can last up to 20 years. And how are we able to do that, especially given the various risks involved, from construction right through to operations and even maintenance risks? Well, we're able to do this by successfully mitigating the risks, and that's what successful project finance deal makers do. Let's have a look at some of these risks and how we potentially mitigate them. So, when we first start off in a project, we've got construction risk and engineering risk. So how do we mitigate against the risk that once we construct a plant, it doesn't operate to specification, or that the components that we're using don't work as we were promised? Well, we have warranties on the plant equipment, and we also have insurance. How do you mitigate the risk that the construction contractor doesn't complete the plant or completes it late, is delayed? And with project finance, that's a big issue because we've got debt that needs to be paid. Well, how we mitigate this is delay damages that need to be paid by the construction contractor to the project company, and the project company uses those delay damages to pay their debt. We have liquidate damages, which may also include buy-down. Buy-down LDs occur when a plant doesn't perform to specification. So it was specified, let's say we're building a power plant and it was specified to output a certain number of megawatt hours per day, and it doesn't do that, it outputs less than that, then the construction contractor will pay a buy-down LD to the project company, and the project company uses that buy-down LD to pay off a certain portion of the debt, such that the ratios, your project finance ratios, which we've spoken about before, your DSCR, debt service cover ratio, your loan life cover ratio, LLCR, and your project life cover ratio, PLCR, are maintained as to what they were at financial close. We have performance bonds to ensure that, the construction contractor does complete the job, or we can hire somebody else to complete the job. We have turnkey agreements. Turnkey agreements literally means that the construction contractor gives you the plant in such a manner that you turn the key and switch it on. So there's nothing you have to do as an operator. The EPC party does the entire construction for you up until the point that the plant is ready to be switched on. We also may have parent company guarantees, where a parent company will step in to fund a contractor if that's necessary. We also have supply risk. So supply risk is that whatever we are producing, we may need input. So let's say, for example, we need coal input to our power plant. Coal-fired power plant, we need coal. Well, what if we don't get enough coal to produce electricity? That is a supply risk. How we mitigate that is with supply agreements, using reputable suppliers, and we can even hedge the prices of inputs if we worry that the prices might blow out and we are fixed at selling at a certain price, but now our input price increases to a certain extent that the plant is no longer generating enough revenue to service its debt. We can actually hedge prices of inputs. Market risk, that's the risk that whatever we're producing simply isn't going to be sold or people don't want to buy it. How we mitigate against that is with off-take agreements. So we sign an off-take agreement with an off-taker who says, I'm going to be buying whatever you output at a certain price. We mitigate it with also market studies and analysis, so understanding whatever market we're operating in. If we aren't able to have an off-take agreement, we do a market study, and also hiring market advisors. There's political risk. How we mitigate that is with political risk insurance, also known as PRI, and also letters of government support that show that wherever the jurisdiction which this project is operating is supported by the government there. Force majeure, we have insurance. Legal risk, we obtain a legal opinion. Obviously, lawyers are involved throughout the deal-making process in project finance. Operations risk, well, that's the risk that the plant isn't going to be operated properly or something happens during operations. How we mitigate this is by hiring a competent operator, by having insurance in place, and also by ensuring that there are maintenance and inspection obligations to ensure that they maintain the plant properly. We can inspect the plant whenever we need to. We have maintenance risk as well. So that could be, for example, the risk that we suddenly, after 10 years, have to replace a major component of the plant that we maybe knew about, but we simply don't have enough cash flow in order to do that. Well, how we mitigate against that is by building up a maintenance reserve account, or MRA, which says, you know what, in 10 years' time, we know we need to replace this major part. It's going to cost $10 million, and we build up the $10 million over the project life over the 10 years, so that by the time we need to replace the plant, we've got that in the bank. We also mitigate it with maintenance and inspection obligations. Environmental risk during construction operations. For example, during constructions, what if we're digging to lay the foundations of our project and we hit a fossil? Or we find out that actually the ground is not suitable? Well, we hire technical advisors during financial close process to really inspect that and understand what the risks are there. And during operations as well, we may take advice from specialists, and there's also insurance to cover us for any environmental risk which may be incurred. Finally, we also have syndication risk. Will banks participate and to what extent? And to mitigate that, we have an underwrite agreement signed by typically the lead bank. Then we have some risks that can actually be assessed and mitigated using our financial model. So we have a cash flow risk. That's the risk that there simply is not enough cash flow to service our debt on a periodic basis. How do we mitigate against that? Well, we analyze the debt service coverage ratio on a period-by-period basis, and also forecast and historical DSCRs in the model, and we also run stress scenarios. Cash flow over the loan life, well, we've got the LLCR for that, and cash flow over the project life, we have the PLCR. And I've spoken about that in my article and the video on project finance coverage ratios. We have model risk. There are two types of model risk. What if the engineering model is not correct? Well, we've got a technical advisor. The lenders and the sponsors will have technical advisors looking at that. And the financial model, we have a financial model auditor and also pre-checks. There are firms that offer pre-checks prior to a financial model audit, prior to the banks going to credit committee and the sponsors going to investment committee and the equity going to investment committee, who will actually perform a high-level analysis of the model in order to mitigate that risk. Equity risk, that equity will be obtaining an appropriate equity return. Well, that's measured in the financial model. Repayment risk, that the project incurs an issue and can't repay the debt. Well, we've got a debt service reserve account, which basically that forecasts the next 6 months or a year worth of debt payments and put that money away in a reserve account. So in case an issue does come up in the project, they've got 6 months to a year to resolve that issue, and we draw on the debt service reserve account to pay the debt. We'll also assess financial model ratios. We limit the size of the debt, and we limit any additional debt the project company is able to take on. Accounting risk, well, we get an accounting opinion for that. Credit risk, the bank obviously prices appropriately with interest rates for that risk. And the financial model is used to structure the deal and assess the credit risk and ratios involved. Then we have some risks that can actually be hedged at financial close. That includes foreign exchange risk. What if the capital equipment for our infrastructure deal is coming from overseas and it's in a different currency? And what if the currencies blow out and suddenly our capital equipment is much more expensive? How do we mitigate against that? Well, we hedge that currency risk so that we don't have any currency risk. We can also hedge currency risk if our debt is in a different currency or if our revenue is in a different currency. And we can hedge currency risk both during construction and operations. Interest rate risk, what if our base rate interest rate increases and our interest payments now need to be much higher because of that increase in the interest rate? Well, we can hedge the interest rate. And sometimes the interest rates are hedged on a hedging profile. So it's 100% during construction perhaps, and then decreasing as the project becomes less risky or as debt is paid down. We may also have currency risk, as I said, for revenue, maybe in a different currency. Maybe our project is in a different country to the one which the sponsor operates. So how do we hedge against that? Well, we can obtain political risk insurance. We can also have offshore reserve accounts as well as currency swaps, and we can hedge that risk. I hope you enjoyed this video, and that gave you a good indication of what some of the risks and risk mitigants are in a project finance and infrastructure finance deal.